my name's Jon Voorhees, and I'm an advisor with Peak Performance Consulting Group. And today I'd like to talk to you about 3 important considerations if you're thinking about closing branches. Now, why close branches, right? Well, everyone knows there's been a real revenue dearth over the last several years with interest rates so low that margins have gotten squeezed. So all banks, credit unions, community bank, big banks, no matter your size, they're looking at ways to get costs down while they're waiting for the opportunity to grow revenue faster. And one straightforward way that everyone looks to is, I've got to get my physical infrastructure costs down, so I have to close branches. And whether it's a big bank like Bank of America that's closed over 1,000 branches over the last couple of years, or a small bank who's closed 4 or 5 out of a network of 40 or 50, it doesn't matter. These 3 things are important considerations if you're to be successful in doing this. First off, you need to have a long-term strategy. And that means every year you want to look at all of your distribution to say, do I keep it, close it, or move it? Whether it's branches or ATMs, they all work together. But the important thing is you want to have an understanding of the value of every site that you use. And the reason for that is you might identify sites that you want to close, but you may not be able to do it immediately. One, it may simply be that you have 5 years left on a lease term, and if you close it now, you're going to have to buy out of that lease, and that cost offsets all the cost savings you're going to get. So once you have a good understanding of your long-term strategy for your network, you can then schedule things to happen at the right time. The second major consideration is, how am I going to be able to keep my customer base? So you really want to take into account how customers are using your location, the one that you want to close, and relative to all the other locations that they use. If you find that you happen to have a customer set who are very wedded to one particular location, they're dependent on it, a very large percentage of your customers who are using it. It may be simply because you don't have any other distribution around, or it may simply be they have really good service and the like. But if you want to end up closing it and you have a very high dependent customer base, the number one factor I found around attrition is dependency. And you really need to take into account the users of that particular space, users of that particular branch. So to give you an example, one of the things I found over the years, and by the way, you might want to even ask, well, why is this guy talking to me about this? Over the course of my 30-plus year career, I've worked for several major banks. And I've probably closed more branches than anyone alive today in the U.S. I've closed over 2,000 branches as part of my career, including opening 1,000 branches. So it's not just all about closing. But back to my point. When you're closing and you're looking at dependency, you want to understand, are these people already using some alternative channel or alternative locations such that if I close this, they'll simply go to their second choice? If they're not, if they're only using this one location for all of their banking needs, in essence, that branch is the bank to that. And if you close it, they're highly likely to leave. Over the course of my 30-plus year career, we've tracked consolidations and we've tracked what's happened to the customers. Customers that are exclusive users of a particular branch, if you close it, you are likely to lose the bulk of that business, and that can completely undermine your cost savings. So having a long-term strategy and then picking locations that have customers who aren't that wedded to it. They use a lot of other locations because those customers will simply switch off. The third long consideration, the third point you really need to consider is, how do I retain the sales? And this is key. If I can retain the majority of my customers because they already are using many locations within my bank, then I can retain the sales that were going on because about half your sales are probably cross-sell to existing customers. And that's really critical for a couple of reasons. You're going to get the cost savings. You're going to have some runoff or attrition of customer base, but you're not only going to retain the revenue stream that those retained customers, you're going to retain all those cross-sell activities that were going on. And as you do that, that replaces the natural attrition that's going to go on in that impacted customer base, and that's how you get your cost savings maintained long term, Think about it like this. You're going to get a one-time cost savings, and it's mainly going to be tied to the occupancy expense for the branch and other operating expenses of the branch. You might save half of what it costs for the branch, but you're probably going to keep the people, and they're going to go fill other jobs within the bank. But then, if I can keep the most of the revenue, and I can keep the ongoing incremental revenue stream driven by new sales off of those existing customers, then my cost savings become permanent. And that's really the key to this. You want to create permanent cost savings long term. Now, if you find that in some cases, if I'm going to do this, I might need to add back a remote ATM in order to maintain that customer base, because while they're dependent or not that dependent on it, I really don't have a secondary option nearby. So add back a remote ATM or something like that to make sure that they have transactional point, keeping the customers happy even after you've taken away one of the key distribution points for them. So let me recap that. Everyone's trying to get costs down. One of the ways to do it, most straightforward way, is to do branch closures. Where do you start? You create a long-term strategy. You look at all the different factors that influence it. You look at your customers, how they're using your branches, and you identify those branches with little upside opportunity. You look at those centers that have weak performance. They may even be profitable, but they may never get much more profitable. You look at how the customers are using it, and you let the customers tell you whether you can get away with closing it. You look at the timing associated with it. If it's owned, you can pretty much close it at any time. But if it's leased, you really want to take into account when the lease is coming up. And then finally, you want to look at what are things I need to do to retain the customer. You want to make sure you're doing outreach programs. You want to make sure you're giving them enough time to adjust to stay with the bank. Long term, if you do those three things, you're going to get cost savings out, you're going to keep the bulk of your customers happy because it's really a non-event, and you're going to create permanent savings for the bank. Thanks for listening to me today.